Manoli is here under a co-sponsorship arrangement with the Economic Self-Sufficiency Policy Research Institute based at UC Berkeley. So we're really pleased to co-sponsor this event with them. And secondly, Dr. Manoli has deep roots in California, having graduated with his PhD from UC Berkeley. Prior to that, I guess you were an undergraduate at the University of Chicago. He's been all over the place. So, as you know, Professor Manoli he's an assistant professor of economics at the University of Texas, and he's going to talk about a topic that, broadly speaking, is really central to the mission of the UC Center, and something that I think we all know is really important, which is just making government work. If we're going to have a government, let's make it work efficiently and effectively for people as we possibly can. So we look forward very much to your remarks. Thanks, Professor Manoli.
Thank you all very much for coming. So in addition to going to Berkeley, my first job was at UCLA, and so California is very, very close to my heart, and the UC system in particular. So I'm very happy to be here. So yeah, as you can see from the title of the talk, I'll be talking about academic and government collaborations and the use of administrative data to think about research and policy. So, let me just start by mentioning that, as many of you are aware, there are a variety of government agencies, at both the state level and the federal level, that administer a variety of programs. And as part of administering these programs, they collect a lot of data. So there's a lot of data at the state and federal income tax level, thinking about Medicaid, SNAP or food stamps, welfare programs like TANF, unemployment insurance. There's education programs like for financial aid. And so there's a variety of administrative data sets that are collected as part of a wide variety of programs. Now, at the same time, I think that these data sets have been collected for many years, and there's been a growth in computing resources. I think that, especially here in California, I probably don't have to tell you about the growth in computing resources, but the ability to store and analyze these data sets has really just sort of exploded. So what that means is, well, we can not only just house these data sets, but we can now go back, and think about these data sets going, back to further historical periods. We can digitize records, going back to, think about censuses that are many decades old. We can analyze a large set of variables. So there's, wide variety in ways in which computing resources kind of affect our ability to work with administrative data. So that's sort of a growth, I think, on just the sort of logistics side about computing resources. At the same time, there's been a lot of growth in academic research on thinking about causal effects and our ability to analyze administrative data sets and think about ways to get at or estimate and understand causal effects. So ways to analyze big data. And this could be everything from thinking about daily unemployment insurance claims, thinking about search data, text processing, ways to really understand, okay, so if is filing income taxes in California causing people to search more for certain tax forms through Google or something like that? There's a variety of strategies that we can now use to analyze these administrative data sets to actually answer some of these questions. Now, I think that sort of with these two points here, one of the ideas I think that really kind of rises to the surface pretty naturally is that we want to think about ways to combine expertise in these different areas. So combining expertise from government agencies and academics or academic research can really, I think, lead to a lot of significant progress on a variety of policy questions and also academic questions. So in today's discussion, what I'm going to do, I'll talk about some examples of research that can be conducted with these types of partnerships, and then I'll talk about the strategies to kind of develop these partnerships, and in particular, develop these partnerships in sustainable ways. Okay, so the first part of the talk is really going to focus on these examples of research, and then the last part of the talk, which I think will sort of segue nicely into thinking about a more open discussion, we'll be thinking about these strategies to set up effective partnerships. So these examples and strategies that I'll be talking about, I just want to give a couple of caveats up front. These are going to be drawn from my own personal experience, so they do not represent any official views, really, or they don't represent any views other than my own. They definitely don't represent any official views or opinions of the Treasury, the Internal Revenue Service, or any other government agency, really at the state, federal level, or anything like that. So I just want to emphasize, beyond me, like, I mean, like my wife and my son, like, doesn't represent their views. I'm solely responsible for any debacle or anything that comes up here. But a lot of the examples of the research that I'm going to talk about here, these are examples that are going to be based on interactions with the IRS and the United States Treasury. And I'll try to highlight the co-authors that I've been working with on these projects as well. All right, so let me just dive right into thinking about the first type of project or type of research that can be conducted with these partnerships. So I think first, the first example that I want to highlight is called, what I'm going to refer to as example 1 of low-cost randomized controlled trials. All right, so as many of you are aware, I think in research, when we're thinking about ways to understand and evaluate policies, randomization is really the gold standard. Okay, so this is the gold standard within academic publications, as well as I think even like the popular press. So there's like randomization. Really, the experimental design is something that we're taught, from elementary school hypothesis testing in science class all the way, beyond that. But in practice, when we start thinking about randomized controlled trials, it's often very difficult to implement. And there's a variety of reasons why, but I think 2 particular reasons are, one is that the experiment can involve a costly intervention, so treatment could be pretty expensive. And then another is that data collection can be very expensive. So designing surveys or things like that to collect data for these interventions, even if the intervention itself isn't that costly, the data collection can be very costly. At the same time, though, even though we know that there are these barriers, we still have like a demand, I think, for thinking about policy insights and policy evaluation. And so I think we want to consider some alternatives. So some of the alternatives are thinking about inexpensive treatments, or also working with data that's being collected. Unfortunately, as we just highlighted, there's a lot of administrative data being collected, right? Probably more than like we're even immediately aware. But when we start digging into the weeds on this, we actually start to see that there's very rich data that's already being collected for administering various programs. So we can try to make use of that data. So I think academic experts or academic researchers can start to provide some expertise on thinking about low cost or inexpensive treatments, and at the same time, government agencies can provide access to data that's already being collected. So we can start to combine low-cost treatment with low-cost data collection, and that I think overall can lead to relatively inexpensive or low-cost randomized controlled trials. Let me give you a couple examples of this. So the first example is some work that I've done with the IRS on what we call the non-filer outreach randomized controlled trial. So as many of you are aware, the Earned Income Tax Credit, or the EITC, is it's grown to become the nation's largest cash transfer anti-poverty program. Okay, so just about $60 to $65 billion of tax revenue at the federal level is redistributed to lower income working families and individuals. So the Earned Income Tax Credit is a very, I think it's, there's a lot of bipartisan support for this program, and it's been highlighted as a significant success. But at the same time, it faces a pretty significant challenge of incomplete take-up. So about 1 out of every 5 eligible individuals does not receive benefits that they should be from the Earned Income Tax Credit. So the IRS is actually held on the hook for this because this is an improper payment. It's an erroneous tax payment. So the IRS really wants to get tax payments correct, whether a person is getting more of an income tax refund than they should, or less of an income tax refund than they should. Those are both errors from the IRS perspective. Getting it correct is the essential goal here. So when we start thinking about incomplete take-up and getting people's tax payments correct or tax refunds correct, we want to dig into, well, why aren't people claiming the Earned Income Tax Credit? So the majority of incomplete take-up of EITC benefits, so it falls into what we refer to as non-filing. So there's 2 ways you can not claim EITC benefits. You can file a tax return and not claim benefits, or you can not file a tax return at all. So the majority of this is actually coming from the non-filing program, or the non-filing aspect of behavior. There's a relatively smaller percentage of individuals that file taxes that do not claim EITC benefits. And for those individuals, the IRS does send out a notice to let them know that they should be claiming EITC benefits, but we don't really have a systematic program in place to deal with non-filing. Okay, so these are individuals that could be below the filing income threshold, so they don't have a legal responsibility to file a tax return, but they should be filing a tax return, thinking about it from their own perspective because they could be getting EITC benefits. So what can we do? Well, working with the administrative data at the IRS, I don't want to sound too big brother here, but there's a lot of data that's collected by the IRS. So so even if you don't file a tax return, there's a variety of ways that the IRS is aware that you exist. So for example, if you receive a W-2 and you don't file a tax return, the IRS knows that you exist. Okay? They can tell that from the W-2 that is reported from your employer to the IRS. All right? Even if you don't file a tax return. Suppose you don't get a W-2. Well, suppose you're just a contractor. If you get a 1099 miscellaneous, that will be reported to the IRS as well. Suppose you just you're not employed, but you have a bank account. 1099 interest statement will be reported from the bank account from the bank to the IRS. Okay, suppose you don't have any of those, but you're enrolled in some kind of education course. A 1098T tuition statement will be reported from the educational institution to the IRS. So there's a variety of other forms that are of administrative data that are third-party reported to the IRS, even if you do not file a tax return. Okay, so we can match that administrative tax data on those other tax documents to individuals that do show up on tax returns, and then use that to identify who is a non-filer. Who do we see some tax document for that does not show up on a tax return? We can also see, are these potentially EITC eligible individuals? Of the income that we're seeing on administrative tax forms, do these people look like they have income that would be low enough to qualify for the earned income credit? Well, so then with that set of data, we can identify a population of potentially EITC eligible non-filers. Okay? All right, so now once we identify these people, well, what do we do? Well, we can think about insights from a variety of fields, and in particular behavioral economics, to think about, well, how can we get these individuals to actually file a tax return? Okay, so there are a couple of constraints that we have to think about here. So for example, the IRS, there's a lot of legal issues when the IRS contacts taxpayers. You don't want to create taxpayer burden. You don't want to intimidate people into feeling like it's illegal if they don't file a tax return. So what you can do is, well, you can say, to give you a very concrete example, if you haven't done so already, please file a tax return and claim the EITC benefits if you're eligible. All right, that might seem like a relatively simple statement. It took about 3 months to get there. I didn't realize this, but this is a good example where government-academic partnerships are kind of first order and lead to very clean insights. But if I tell you, please file a tax return, that's actually violating your rights as a taxpayer. Why? Because, well, the way I've identified you, I know that you haven't filed a tax return. And by sending you a reminder, if I send you a postcard that says, please file a tax return, if your neighbor sees that, that's violating your privacy because the neighbor now knows you haven't filed a tax return. Okay, so this is very simple kind of ideas. As soon as someone points this out, that's immediately obvious to me. Okay, so we don't want to reveal fact of filing. Okay, so then we can say something like, if you haven't done so already, please file your tax return. That simple kind of insight protects people's privacy, which is, I think, something that, very commonly all of us can agree on, that's important. But at the same time, we can also remind people to actually please file your tax return. Okay. The other piece, please claim your EITC benefits if you're eligible, right? You don't want to just uniformly get people to file and claim EITC benefits. Some people might not be eligible, right? So you don't want to create improper payments on the other side where people are overclaiming benefits. You want to say, get your benefits if you're eligible. All right, so that's the important sort of, that one line, that is what you want to get across to people. Okay, so if that's the one line that you want to get across to people, put that front and center on the postcard or on the letter. That's like the main headline of the letter that we sent out. we can, we actually conducted a randomized test where we randomly selected a treatment group of the non-filers, and we sent them these postcards. In terms of cost, the only cost was printing and mailing. Okay, so this is also another good example, very concretely, of how these academic government collaborations can work. As you can imagine, the IRS just can't accept outside funding, right? They are the IRS is it is a regulatory or enforcement agency. They can't just be accepting outside funding from anybody. So in terms of costs, these are costs that have to be incurred by the IRS. You do want to think about, well, what costs can the IRS be incurring, especially in this relatively tight budget period. For the IRS budget, I think the most recent budget was actually less than the budget in 2010. So thinking about costs here is actually very practical. Printing and mailing costs are actually relatively low. You can actually get this down to less than 3 cents per postcard, and postage can be relatively low. But one of the things that we did pay extra money for was tracking the postcards and tracking delivered mail. We want to make sure that our mail is mailing actually being delivered to the recipient that is intended. So tracking mail was actually valuable here, but these were relatively low costs overall. Okay, so this isn't additional data being collected or anything like that. This was a relatively small drop in the bucket of the IRS overall printing and mailing cost budget. So I do want to highlight that that was kind of viewed as an important aspect of this project, that it was relatively low cost, and we were just using some of the existing data both to form the sample and then also to evaluate the outcomes. So did people actually file taxes and claim their earnings and credit benefits? So as I mentioned, we use this administrative data. One of the ways that we use this administrative data is to identify the non-filers, and what we were able to do is actually create maps of the non-filing population across the United States. So what we're looking at here is the fraction of non-filers in each county for tax year 2005. The darker red areas are areas that have relatively higher rates of non-filing, and the lighter areas are areas that have relatively low rates of non-filing. So most of the individuals are filing tax returns. You can see, relatively speaking, large swaths of the Midwest characterized by relatively high rates of filing. In the southeast of the United States, relatively high rates of non-filing. And you can also see in California. So if you look in this coastlines and actually like the urban areas, it looks like relatively high rates of filing. When you start moving to some of the more rural areas, that's when you start to see some of the higher rates of non-filing. So I actually I was presenting this at another talk at UCLA, and somebody mentioned well, you see some kind of high rates of non-filing scattered in other parts of the Great Plains. Another researcher that worked on Native American populations pointed out that a lot of these are actually counties where there are large Native American populations and Native American reservations. So we didn't realize this, but this is definitely an area where the IRS tracks an in-need population. But overall, you can kind of see that these are the rates of non-filing in these areas, and there are definitely geographic clusters that we can start to tell stories about and think about. But I also want to highlight, so this is for tax year 2005. We're able to do this for every year and sort of see how these patterns change. 2006, you can see relatively similar to 2005. 2007, the whole country kind of lights up. So what's going on here? Well, 2007, some of you might recall, this was the year of the Economic Stimulus Act. So if people filed a tax return, they would get a check for $300 or $600. So $600 if you're married, and all you had to do was write your name and address in on the tax return and submit the documents. So there were actually a lot of blank tax returns that were filed in order to get the economic stimulus. So what's interesting here is that this is sort of uniform, right? You see some degrees of areas that sort of still persist with higher degrees of non-filing, but clearly there's some responsiveness. Once individuals are aware that there's a financial incentive to actually file, they actually do move into the filing system, right? So what happens after this? Well, you start to see in 2008, things sort of start to come back. 9, 10, 11, 12. You can kind of see things like sort of fade out. Right? So we know that there's some responsiveness to financial incentives. Right? We also know that there was a large information campaign at the time of the Economic Stimulus Act to get the word out there that if you file a tax return, you can actually get your payment. Keep in mind, the payment was on the order of about $300. Why is that number important? Well, that number is actually important because for many non-filers, if you were to file a tax return, the EITC might be on the order of $150, $200, maybe, like on that order of magnitude. You can also get your withholdings back. That will put you in the $500 range to $1,000 range. So you can actually get more money than the Economic Stimulus Act if you were a non-filer and you actually went in and filed your tax return. So you're giving up your withholdings, and that could actually be a pretty significant amount of money when you combine that with the EITC, even though the EITC might be relatively small compared to other amounts. So these are some factors to keep in mind with the non-filing population. You can see 2013, pretty persistent. So all of these areas that were initially high non-filing areas seem to be persistently high non-filing areas. And so this was very useful for the IRS because they can work with their stakeholders like the United Way and other third parties and actually start working with, okay, so if we know that these are persistently high non-filing areas, let's try to increase outreach in these areas and see if we can create VITA sites or get the word out about volunteer income tax assistance sites so that people can get their tax returns filed for free. So this is ongoing work to kind of think about how we can work with third parties in these areas. In terms of the results from these postcards, well, the reminders actually did increase the filing rates. Interestingly, it got individuals to file both current tax returns as well as past tax returns. So many individuals got about on the order of about $1,500 back. So a lot of individuals got just zero back if they didn't respond. But the individuals that did respond ended up filing maybe 2 or 3 tax returns based on their past taxes that weren't filed, and they ended up getting decent check back overall when you added up the amounts over those 3 tax returns. I also want to highlight that, so not only did the simple postcard increase filing, but it also got individuals to pay their taxes that were owed to the IRS. So some individuals voluntarily reported self-employment income. Other individuals, they were actually married when we didn't realize that they were married. So when you combine their household income, they actually ended up owing taxes. But they paid taxes owed to the IRS. This was I think this is a very welcome result at the IRS because voluntary tax filing is monitored by the IRS. So in general, the overall we do pretty well as a nation in terms of voluntary filing. It's on the order of about 80 to 85%. We're getting people, so we were actually able to increase this with just a simple postcard. The effects of the postcards now, they did not persist. So it's not that individuals permanently learned, okay, I should be filing a tax return. That I think kind of makes sense. We think of these populations that are relatively low income. There's a lot of turnover, a lot of churn, and a lot of transient aspects in that lower income population. So tax situations change, and they didn't persist. However, when we did a follow-up experiment where we actually sent out a second round of postcards the following year, we saw that those postcards were particularly effective, and they were actually very effective for individuals that previously filed they filed their taxes and owed taxes to the IRS. Okay, so it's like, well, I walk in, I file 1 year, and instead of I thought that I might be getting a tax refund, actually it ends up that I owe money. Maybe next year I'm not going to file so much. Well, that just because you owed money 1 year doesn't mean that you don't have to file the next year, unfortunately. So maybe if you get a postcard from the IRS, that kind of reminds you, all right, well, you still got to pay your taxes like if you owe them. What's interesting is that people that owed taxes to the IRS previously, when we got them to walk in the door and file their taxes the next year, because of this transient nature of their tax situations, over 50% of them actually got refunds the next year. So even though you might owe taxes 1 year and you have a bad experience and you stop filing, that could actually be a suboptimal decision in the remaining years in the future because you could still qualify for tax refund. So just a simple postcard here actually was very effective for them and got them to get their refunds the next year even though they owed previously. Okay, now let me move to thinking about the second example of research I think can come out of these collaborations. We talked about randomized controlled trials. I think the other another natural step to think about is thinking about quasi-experimental research design. So you can't always set up a randomized experiment. And in particular, a lot of very important policy questions, they're not going to be answered with a low-cost randomized controlled trial. You still want to make some progress, and I think that what you can start to do is start to think about quasi-experimental research designs or natural experiments, ways that you can kind of mimic an experiment using existing program features or existing features of the institutional environment. So academics, I think, have a lot of expertise in thinking about ways, well, I think like one of the ways that you make progress in academics is being creative on thinking about ways that how can I replicate an experiment with credible assumptions here, even though I don't have actual explicit randomization, right? And so you put a lot of expertise in that, but you might not actually have the data to do that, right? So you can try to partner up with some government agencies that do have data to do this. Or, like, I think in my case, what I actually realized is that you can partner up and learn more with these, with government experts about the institutional background. And once you have some of that institutional understanding, you can start to see how can I construct a natural experiment or a quasi-experimental research design. So just to give you two examples, so one, I think, very natural way of thinking about mimicking an experimental design is thinking about a policy discontinuity. So suppose that you have like a program that says, well, if you're below $15,000 of income, you qualify for benefits. If you're above $15,000 of income, you don't qualify for benefits. Turns out a lot of programs actually have those kinds of legislated policy discontinuities in the rules. So one way you can kind of think about this is, well, let's take someone that's at $14,999 of income and compare them with someone that has $15,001 of income. People just above and below this income discontinuity. They're very similar in income. One person's getting exposure to the program, the other person isn't. And then you can evaluate outcomes. So you can think about these policy discontinuities. You can also think about something like staggered rollout. So suppose that I roll out a program in County 1, and then I have to pick where I'm going to do it first. I'll roll it out in County 1 in year 1. In year 2, I'll do it in counties 2 and 3, et cetera. So then you can kind of take into account that, well, I can take into account that I rolled out the program in different areas at a differential time, and I can use that variation to say, well, what happened before and after the program was rolled out. And so that staggered rollout across counties can be used to identify causal effects of the program once it was rolled out. Okay, so how do you actually get to these quasi-experimental designs? Well, you need to know where are the policy discontinuities, where are the programs being rolled out. As an academic, you might not be aware of some of these things, but if you were able to work with some people that do know this, fortunately you could learn where they actually are being rolled out. Well, it turns out that government agencies and policymakers have precisely that expertise. So you can partner up, and I think that you can then start to realize, okay, I know where the policy discontinuity is. I know where the staggered rollout is. Let me start to use that variation to design a quasi-experimental research design that will answer questions that are relevant both for government questions as well as academic research questions. Let me give you an example from my own research that is very recent. So as you are aware, the IRS conducts audits every year. In particular, for the Earned Income Credit, they conduct what are called EITC correspondence audits. So there are two types of audits. One type of audit is a face-to-face or a field office audit. So I think these are maybe, I don't know if you guys have ever seen the movie Stranger Than Fiction. It's with Will Ferrell, where he plays an IRS agent. It's a great movie. It's one of my favorite movies, actually. Not just because it deals with taxes. But it's I'm a sucker for a rom-com, and it's a very good rom-com. So anyways, I think that the face-to-face audits are what we typically think of. It turns out that the majority of audits are conducted via mail. These are correspondence audits. There are about 400 to 500,000 audits each year conducted just over mail. And the IRS requests more information to verify your children, your marital status, or your self-employment income, that type of information. So the IRS can, in contrast, there are about 40 to 50,000, so an order of magnitude smaller numbers of face-to-face audits. So very few face-to-face audits because those are very costly. So we want to know, well, how do these audits actually affect taxpayers? What are the outcomes, of these audits? How do they actually affect taxpayer behavior? Well, looking into this, I learned, okay, so I learned from my co-authors, that when a tax return is submitted to the IRS, it goes through a couple filters. So first, it'll be accepted or rejected at filing, depending on whether certain risk factors are triggered. For example, if like certain things don't match up, if you don't provide a valid Social Security number when you're filing a tax return, that might just be rejected at filing. Now, conditional on being filed, if there's an earned income credit claim, the tax return is run through a bunch of filters to see if any of the filters or flags kind of comes up as being positive. If any of those flags come up as being positive, that flag sort of sets off a protocol to set this return aside for quantitative risk assessment or risk scoring. Okay, so once we have the set of the population of returns that have set off flags and need to be scored for risk, they're run through a risk score calculator, and the highest risk scores are always going to get audited. Okay, so if a return comes back as like, this risk is off the charts, there's something not valid in the return, that return is always going to get assigned for audit. In contrast, the lower risk scores, those risk scores, they're going to be randomly selected for audits. Okay, so the IRS doesn't want to just select the highest risk scores because they want to make sure that they're not missing anything. They want to check and make sure that the lower risk scores, is there anything else that we can learn? And so let's randomly select some of those and see what we can learn from those audits. Well, after learning that, I sort of realized like, okay, well, I can think about. Let's see, we have some random variation here. So how can we design a quasi-experimental research design to understand the impacts of these audits? Well, conditional on risk score, if we condition on these lower risk score where there's random variation, we can focus on that population and then look at outcomes where we have people that got risk scored but were not assigned for audit, comparing them to people that did get the same risk score and were assigned for audit. And then we can just look before and after the random selection. So here we can, so here's the sort of just summary of the quasi-experimental research design. But I just want to highlight this isn't really possible unless you know the institutional background of how the IRS is conducting audits. That's not going to be possible I think just purely from academic research. I think it is crucial to have both government experts as well as academic experts putting their heads together in order to arrive at this final research design. Okay? All right, so now let's start to think about the outcomes. What do we actually learn from this research design? Okay, so here I'm just showing you some results. So this is a paper with my co-authors at the IRS. It was just released in March. Actually, as you can imagine, it took some time to get public disclosure approval, given that we're talking about audits from the IRS. But so here we're looking at claiming EITC for wage earners. We have years since random assignment on the horizontal axis. And we have two groups. In red, we have the group that was randomly assigned to be audited, and then the other group in blue that was randomly assigned to not be audited. So they have the same risk scores, but were not randomly assigned to being audited. So you can see that these are pretty similar, almost identical trends prior to the year of being randomly assigned for audit. So in terms of claiming EITC, everybody mechanically claimed EITC in the year of the audit. Immediately after, you can see that in the red line, the individuals that were audited have a much lower rate of claiming EITC benefits. They got audited in year 0, and they actually dropped down by about 20% in terms of the rate of claiming EITC benefits. The individuals that were not audited, about 75% of them claimed EITC the next year, compared to about 55% in the audited group. So a lot of individuals got audited in the past year and decide going forward in the next year, I'm not going to claim EITC benefits. The effect of that audit actually, it sort of dissipates, but there's still a lower difference 6 years after being audited. So this is somewhat important to think about. Well, the IRS wants to get tax returns to be correct and get EITC payments correct. But we sort of think about this as a whack-a-mole problem. You might be getting EITC payments here correct, but in subsequent years, you might be creating a problem of individuals actually filing taxes and not claiming EITC benefits when they should be. Right? So these could be the individuals that are actually filing tax returns and then not claiming EITC benefits. So they could be the filing non-claimants. Or it actually turns out that a lot of these are actually non-filers as well. So a lot of these just drop out of the filing system overall. And so you start to think about, well, okay, so now you're getting tax payments correct in 1 year, but you have to weigh that against something that you might be creating a problem in future years as well. So what can you do? Well, you can think about post-audit follow-up. maybe send these guys a postcard that just says, even if, don't forget, you might need to file your tax return for this year. Or if you're eligible, please claim your EITC benefits for this year. You can send, just like give them a reminder, even after they've been audited, just to let them know, the IRS still wants you to get your taxes correct, even if you were audited in the past. So a very simple kind of phenomenon. So this is for wage earners. We actually see similar behavior for individuals that are self-employed, maybe even a little bit more stark. What's also very interesting is that it turns out not only does this actually affect their net tax-paying behavior, it actually affects their labor supply and their earnings. So we see. So what we're looking at here is the change in the wage earnings on the vertical axis by their income on their audited tax return. And you can actually see for very low income individuals, we see a large increase in individuals at zero income. So what that's highlighting is that after the audit, wage earners, a good chunk of them, or a statistically significant and important amount of them, move to zero earnings. So after they have their EITC benefits disallowed, they stop filing, and a lot of them actually drop out of the labor force. So this is so the IRS is actually interested in this, not just in the purely academic labor supply sense, but also in the sense, well, the EITC is championed as an anti-poverty incentive to work, right? And well, you have some evidence that it's functioning like that. When you take away the EITC and you take away that incentive to work, people stop working. So now you actually want, you want to think about, well, should they, maybe we sort of created this problem because like the audit had a very long-lasting impact. So in that case, if that's right, then we can conduct the post-audit follow-up, let them know, okay, you know what, you can still file your tax return, you can still get the EITC even if you were audited previously, and maybe we won't see as many individuals drop out of the labor force subsequently. So this is work that, again, is ongoing, but without this sort of I think partnership, we wouldn't be able to have this research design, and we wouldn't know about these kinds of policy insights. Okay, the last kind of area that I'll talk about is thinking about RCT evaluations. So, a variety of government programs actually do conduct well-designed RCTs, and they know, that these are the questions that are of policy importance. They can also provide, academic insights. So these are being conducted, but you can actually start to think about, ways that you could, use other administrative data sets to evaluate the long-term effects of these. So let me give you an example related to job search assistance. That comes from some of my own recent research. So the Nevada, the Nevada Department of Labor, they worked with the U.S. Department of Labor, the federal, and the state collaborated to administer a job search assistance randomized control trial. The idea was to take unemployment insurance recipients and reassess their eligibility. And if individuals continue to be eligible for unemployment insurance benefits, offer them job search assistance. So personalized assistance on how to fill out a resume, what job referrals, like the types of jobs they might qualify for, and basically offered one-on-one job counseling services. So the Department of Labor at the state level has unemployment insurance records to monitor unemployment durations. So you can see, okay, we have set up this randomized control trial. Some people get access to these job search assistance services. Do they actually reduce unemployment durations? Turns out they do reduce unemployment durations. The people that got job counseling services actually did have shorter unemployment durations. They left the UI roles sooner than other individuals. Okay, so that provides a very clean policy insight. But I think another very natural question is, well, did people find jobs? Did they actually move into employment, and did they stay permanently employed? Or did the control group actually end up catching up? Did the people that didn't get the services, did they ultimately catch up in the long run? Well, in order to do that, you might need income tax data so that you can actually track people beyond their unemployment duration. So you would need the Department of Labor to be working with Franchise Tax Board or with another government agency that can provide that earnings information or that employment information. And that's I think where academics can start to partner up and actually provide this information. And so this is just some of the institutional background on the Nevada experiment, but just to show you some of the results, since we're short on time, I just want to highlight that, well, actually what you see here is when we looked at wage employment, so you can see prior to the intervention, wage employment for the treatment and control groups are pretty similar. after the intervention, you see a permanent increase in wage employment. So not only did individuals leave unemployment insurance sooner, but they found jobs, and they stayed in those jobs even 6 years later. So there were permanent effects created by these one-on-one job counseling relationships. And it's not that the control group ever caught up. So you took some people that wouldn't have otherwise found jobs and actually created new employment for them. And this is not the case that I found a job sooner than I would have. It's just that I found a job versus I wouldn't have found a job if I didn't have access to these services. And that's persistent well after the intervention. The other point that I want to highlight is, with other data, you have other outcomes that you can look at. We were able to look at home ownership in the tax data. If you were a homeowner or you have a home loan or a mortgage, you actually receive a tax statement that's turned into the IRS. So it's a mortgage interest statement. And interestingly, we can see that this program actually had a pretty significant impact on home ownership. So for the control group, so these were all people that became unemployed, they had a very significant slide down, decrease in their home ownership rates. The individuals that were in the treatment group that had the job counseling and found employment, a much shallower decrease in home ownership. So you can start to use administrative data to get a more complete sense of what's the impact of a job search assistance program. It's not just on unemployment durations, it's not just on wage employment, but it's even starting to impact family level variables like home ownership. Okay? So let me just finish up here with a couple insights and thoughts on setting up these collaborations. I think it's important to keep in mind two principles. So one is thinking about human capital development, and the other is thinking about a long-term outlook. In terms of human capital development, I think it's really important to think about this on both sides, both the academic side and the government side. I think about one of the most valuable experiences that I have from my own interactions with Treasury and the IRS and Department of Labor is learning from all of my co-authors. I've learned a tremendous amount from all of them. I've learned, things that maybe I should have been an expert on to begin with, like thinking about research designs. I've actually learned a lot from them. I've learned, also a lot of institutional background and details on government policy from them. At the same time, I've also been able to provide some data analysis expertise and train some of their staff as well on how to do, just basic things like constructing maps or like doing some of these, randomized control trials. The other piece here is the long-term outlook. I think in terms of thinking about this as like a one-time project or a longer-term project, you want to be thinking about this as this is going to be a long-term interaction. Okay, so this is not, I think that'll become a little bit clearer here. When you think about people that you're going to be working with long-term, you want to do some background checks. It's not just a background check on I did have to get fingerprinted and things like that, like a security clearance. But you want to go beyond that and think about who are some of the people that you trust and you can actually disagree with? Someone that you can say okay, I want you to push back on this, but here's what I'm thinking. I know that they're going to feel comfortable pushing back. At the same time, if somebody tells me that, all right, Day, I want you to feel comfortable here, but there's absolutely no way we can disclose this paper. Feel free to push back. If I don't feel comfortable on that, that's going to be a problem, right? So you want to have that kind of understanding, I think, of each party's interest, and you want to be as upfront as you can about appreciating those interests, and talk about how those are going to be met. How are you going to meet the tenure process, the pressures of publication lags, when you also have short-term policy deadlines to think about. So the IRS is actually starting to think about okay, so we're doing audit outreach or things like that, starting to think about that this summer. We just submitted this paper for publication. Maybe we'll hear back in November or December, right? So, and then it'll be another year-long set of revisions. So we have to balance those things, and I think we just talk about that very explicitly. The last thing is thinking about some of the formal logistics. So, I think that oftentimes people set up contracts or MOUs. Procurement will all kind of get involved when data is being delivered or transferred between parties. I think that these kind of seem a little bit short-term, just in that they're focused on deliverables with a very specific timeline, and it's very difficult to kind of change some of these things or renegotiate contracts. So if there's an unexpected setback, unfortunately, this paper wasn't accepted for publication, so it's going to take another year in the publication pipeline. So we need to, spend more time with that, or we need to revise this because some editors pointed out, like a setback or something else, or a shortcoming, we want to be able to accommodate that. So I think instead of contracts or MOUs, we can think about visiting scholar positions and details. The point that about flexibility I already made, but I also want to highlight this point about working on site. I think it's very important to bring individuals in and create collaborative spaces, not just as a physical space, but at a more meta level, if you will. Like both kind of we actually sit and talk face to face, and I find. As great as FaceTime and Skype are, there's something about like the ability to interact one-on-one or with a group face-to-face and discuss ideas that's very, very valuable. So I think there's more opportunity for interaction and development when you have these meetings on site, and you don't just send off the data and then 2 or 3 years later hope that like nothing's gone wrong and that there hasn't been a privacy disclosure. So I'll stop there, and I'm happy to open it up for more questions and talk more about the research or these thoughts on collaborations. But